This week got 3 items on the agenda. Quick market update with a focus on bonds. Secondly, linked to that, inflation expectations. Where does Coutts stand on inflation? And finally, a look at results, in particular financials. Market update, relatively quiet in equities, so-called sideways markets. Where we have seen some volatility is in government bonds. They've sold off sharply, partly reflecting inflation fears. Linked to the market performance this week is inflation expectations. So inflation expectations have edged up, and we have seen some limited outperformance of inflation-linked bonds. In fact, Coutts does not own any inflation-linked bonds in portfolios right now. Why? Well, actually, we think in essence, they're not in inflation-linked bonds. If you look, for example, the last 5 years, they delivered spectacular returns of 70% when inflation's come down. How is that? Well, the reason is they're more correlated with general interest rates, not inflation at all. And anything that can return 70% can lose 70%. And embedded into the structure of inflation-linked bonds is an inflation rate already. That's currently 3% embedded, but inflation's only 2%. So current inflation 2%, embedded into the structure is 3%. So you're really paying up for something. Put simply, inflation has to be over 3% over the next 10 years before you make any money on inflation-linked compared to conventional gilts. So we have none in the portfolio right now. Final point, corporate results. Generally been positive. There has been some misses, as there always is, of course. Where we have seen some encouraging progress is in financials, admittedly against very low expectations. So we're talking about banks here. What's the Coutts view? Coutts very much likes in portfolios taking credit risk on banks as opposed more to taking equities. We, of course, do have some exposure to equities, but the big exposure is in financial debt. Why? We see this more of a profitability issue, sustained profitability issue rather than a solvency issue. And so we think you're handsomely rewarded for owning financial subordinated debt. So that's a key point in the portfolios.